What if the most stable part of your 401k is actually the biggest risk you own? Right now, your retirement is being quietly moved into a black box called private credit, and the doors are starting to lock. Behind your blue chip logos, your money isn't being lent to companies that traditional banks would touch. If the market value and gated accounts where you can't withdraw your own cash, Wall Street calls it yield, I call it a ticking time bomb from Main Street. Let's talk a little bit about public transparency versus the private fog that is associated with private credit. Public stocks have SEC filings and there's second by second pricing. You can see this on any stock exchange or ticker. Private credit is foggy. You're trusting the fund manager to tell you what a fund is worth. On my podcast, we often discuss how Main Street gets the leftovers while Wall Street gets the data. This gap is where your retirement returns can go to die. So what's the difference? Why would someone turn to private credit? Well, a big shift happened after the 2008 crisis. More regulations for big banks pushed borrowers towards smaller lenders. Independent funds became investment firms and hence started lending money to larger corporations. Another reason the actual returns inside these private equity funds. Some of these funds were promising higher returns as you had higher risk versus return. But inside these private equity funds, you can find illiquidity inside these funds. In the funds, you have different types of investments that may be locked together. Some may expire at one time. Some may expire another time. You hear the term lockup term or lockdown time. Not lockdown, but lockup time where your money's actually tied up and you can't take it out. A recent big blow up here that has private equity and credit markets shifted and shaking is the blue owl locking up of their funds or not allowing distributions to the fund's recipients. This takes people by surprise, but I imagine somewhere in that paperwork, and you have to look deep in the paperwork to find these type of things, Blue Owl has some statement that saying that they can lock up your funds. I don't know if you all have seen the Big Short movie, but there's a part in there where everyone's about to take all their money out, or he anticipates that they'll take their money out. He calls the individual investors and tell them that there's a lockup here. They can't get any of their money out. He won't allow them to get any of their money out. Perhaps Blue Owl had their reasons, and this is the type of stuff that, as you've seen here lately in the stock market, caused the private credit firms to sell off, private equity firms to sell off. So once again, what's inside of private equity and private credit? Why do people shift to this way? Another reason is diversification from the normal S&P 500. But like I mentioned before, sometimes these private firms or even public firms go out and receive funds from these private investment funds. So your money's still tied up inside one of these public funds inside one of these private funds via the public funds. So it's just all mixed up inside there. Another thing is with the SEC oversight inside of a 401k, you can expect the fiduciary duty. But when money moves into private deals, the layers and the fees can be staggering. It's a central theme of the Wall Street South Journal. The migration of capital from regulated sunshine into the shadows of the South and beyond. What you'll find inside of these funds, sometimes with these higher returns, you'll have higher fees attached. If you have different funds attached together, each fund may carry their own fee inside of that, plus a management fee for putting together this fund, managing this fund. There may be a turnover fee if there's action inside these funds. Think of private equity, you can think of a company like, and this is more of an asset, more of a diversified Fundrise. They're a REIT fund that invests inside different type of funds. Started about 5 years ago. Well, they might have been around longer than that. But recently they sent letters to their shareholders. Full disclosure, I have a Fundrise account. They sent letters to shareholders saying they bought a fund that bought part of SpaceX. So now you get exposure to that. But it's not really transparent as to how much they bought or what the actual fund is, when the lockup time is inside these funds. So there's a lot of fog in there. Investors may not even know they're invested inside of these funds. So that can cause huge problems when it comes time to redeem your funds or if you need any money. A good rule of thumb in general, first of all, is know what you're investing in. So know what you have inside of your accounts, know why you have that inside your account, and make sure that it reaches your long-term goals. Apply some type of reasoning behind why you have this allocation and a time horizon. If you're closer to retirement, and you have private credit in there and it's a fund that's locked up and you can't take the funds out for 5 years and you don't realize that, but you retire in 3, And if you are able to take them out, maybe you have a penalty, maybe you have a big fee for early withdrawal. This could be really hazardous to your retirement plan. It could cause you to work longer. It could cause you to live at a reduced standard of living. There's just a lot of implications in that. If you have a longer time horizon, if you're a younger investor, these private credit firms usually work a little bit better as they take time for these investments to grow. They may be investing in a company that's just starting up, a company that doesn't have revenue yet. Sometimes they're looking for companies to be sold before they can actually return any revenue back to the investors themselves. Inside private credit, you have inside of 401ks. There was a bill signed last year into law that allows 401k providers to allow private credit inside of your plan at work. They're still working out the logistics. Some people already had these type of things, alternative investors inside there. But this is definitely a move that's coming, and it's something that may be presented to you, Main Street. So if they do present something like this to you, we want you to be informed and able to take care of it. What is shadow credit? Think of it as a shadow bank. When a mid-sized company needs 50 million, they don't go to a traditional bank anymore. They go to a credit fund. These are bespoke, high interest and high risk. Main Street meets Wall Street collision. Your local economy is being fueled by your own retirement debt. Think about that. But like I said before, why now? Because for years, traditional bonds paid peanuts. Fund managers became desperate to hit targets. They turned to private credit for that 10 or 12% hero return. As we talk about on LinkedIn, newsletter, and all those places, those yields come with a high price. And like I mentioned earlier, your liquidity. And now we're back to this weird reality where we're at, right? Where here we are, where these things are coming inside of our investment accounts. And there, like I mentioned, is an illiquidity trap, the weird part. Everyone sells stocks, the system holds, but you can't even sell a piece of a private loan instantly. So that's the illiquidity. The market panics. The fund might gate your money. Your 401k becomes a Hotel California. You can check in, but you can't leave. Private credit valuations are often marked to model, essentially. A professional guess. That's real high level, but this creates a false sense of stability. With the Monarch Money, you can track net worth. Also put a little skepticism filler on the non-public assets. If your 401k looks perfectly flat while the S&P 500 is tanking, you aren't safe. Maybe you're blindfolded. But it just gives you tools, and you see you're spending every day. You can share it with your financial advisor. You can share it with your spouse or your partner. I'll leave a link below for Monarch Money. If you use the tool, I may be confiscated. Now, I want you to know something. Credit is not. People always want to put private credit as a scam. It is risky, and it's a sophisticated tool, but it was never meant for the set it and forget it retail investor. You're now a silent partner in a venture capital fund. To manage this, you need a high-level view of your entire portfolio. And once again, Monarch Money can help bridge the gap between retirement accounts and liquid accounts. Another thing to consider inside that high level is that private credit, the access and the returns, and that private credit is not all bad. When inserted properly inside of a portfolio and with a proper time frame, if you can get 10 to 12% returns from something that is a diversifier inside your portfolio, that's not a bad thing. You need diversification, especially inside of when you're investing for long-term growth and long-term returns. Far too often we see people with too much single stock risk inside of this. So if you have an opportunity to invest outside of a fund, maybe you should take a little opportunity. But once again, if you're closer to retirement and you're inside something that you can't completely understand, if the person's trying to sell you this fund or get you to invest in this fund and they can't explain it to you simply, you probably shouldn't jump in that fund. But also know when you look inside your 401k at work and you see some new funds and options that those may be private credit, and you may need to speak to someone, the plan sponsor, someone at your job, just to find out what exactly these funds are, why they are in your retirement account, what you can do to improve these. And if these even fit your time horizon, right? Why is this inside your account if you're about to retire in 2 years? Or maybe your question is, why is this not inside my account if I'm going to retire in 30 years? So it's just questions inside of the private credit market that are still open in the air, right? But some of these questions are going to be answered. You just have to give it time. But be careful. Time is money. Time can cost you money. Be careful. We launched the Wall Street South Journal. My goal is to get 1000% clarity to not just their subscribers, but to anyone on Main Street. I want to help empower Main Street with the tools that Wall Street uses to stay ahead. Main Street meets Wall Street is just a great thing. It's a great vision. It's how we operate. It's more than me, for sure. We have the journal. the Wall Street South Journal newsletter bi-weekly on LinkedIn. Have the Monarch Money app, which I can share with you. I have an affiliation with them. It'll be in the link. Description will be in the link. Also have a LinkedIn page, the YouTube channel, the Main Street Meets Wall Street podcast, and all these things are just for financial literacy and financial education. And when I'm not doing this, I also am a financial planner, uh, owner of the ABC Squared financial planning firm. Also inside private credit, let's just talk about alternatives, a little bit inside of alternatives, because different alternatives can be inside of private credit. So you may have an alternative is anything that's not generally a stock or a bond per se, or a stock per se, an equity. So bonds could be considered alternatives. Annuity could be considered alternatives. This gold and silver and precious metals that we've seen lately could be considered alternatives. And private credit can be considered an alternative investment. Private credit could actually have some mix of all of these inside of one fund. So once again, just know what you are invested in. Have the proper time horizon for every investment that you're making, because you just never know when the proverbial bottom will drop. And if you need this money, if you need some money liquid, you shouldn't put your liquid money inside of a private credit fund, unless it has specific times when you'll be paid that you know you can count on the money to be distributed, and it's easy to access your money. And that's usually access your money without penalty. And those are usually things that are not particularly tied to private credit, right? Another big thing with the private credit that we're seeing, so back to Blue Owl, for example, when they're pulling back, we see that it's based on data center build-outs and not being able to fund data center build-outs, or maybe need to pause on that. And that's playing into the larger AI play as well. So people are starting to feel the ripple effect of throwing that rock into the ocean, which we started to see early in February 2026, the SaaS software as a service sell-off. And we've seen companies like Altruist and Hazel. Full disclosure, I use Altruist as a custodian for my clients. Just disrupt. So disruption is not over. There's still more disruption to come. But stay invested. Time in the market is always greater than timing in the market. Know what you are invested in. It's one of the largest things that you can do. Got a little homework for you. And after your days moving to stock market, log into your 401k tonight. Download your Summit plan description. Search for alternative assets. If you find them, you need to know your exposure. Subscribe to the Main Street Meets Wall Street podcast for the why. Join our nearly 1,000+ strong community at the Wall Street South Journal, and download the Monarch Money app via the link that I'm putting in the description. Knowledge is the only way to clear this fog. I'll try to take you on as deep a dive as I can. On the Main Street Meets Wall Street podcast that we have going, the series right now, and this is an independent series, we're bringing in experts and from Wall Street to sit down and have a conversation with me, where I'm just trying to break things down to Main Street. We've had shows on options trading, how it can work for someone 25 or 65. We've done shows. We have episodes coming up on blockchain. We had a recent episode on the tariffs, Supreme Court's tariffs, decision, everything moving, we're covering. Everything moving in a dynamic fashion, we're covering. Look for a little tempo. We'll do a video, something like this, where we just break down concepts once a week for the YouTube. And then we'll have the newsletter that comes out bi-weekly. Articles will be published in between that. Also, the podcast will come out where you'll have a great technical breakdown. The new podcast is coming out. We're going into the national debt, where some estimates have it from $65 to $105 trillion for the debt that we have to service. Also noting in the debt and the amounts that we've seen, private credit was in the billions, low billions before the explosion. Now we're sitting in the trillions of amount of money invested inside private credit. I digress. LinkedIn, check me out on LinkedIn. There's a lot of stuff I'm always posting there. The YouTube channel will have a regular posting. There's actually a section on YouTube where I do tutorials, where I can just show you things. One of them is the Trump accounts. I don't know if you've heard anything about those, but go in there, check it out. It has the link, and then it has a deep dive into just going through the website, going through what these accounts are for, how they actually work, and how they look. It's pretty rich information. I'm not on screen for that one. Like I said, it'll just be a section for tutorials. Then you'll also have your part for information here. You have the podcast. So we're just spreading information. That's part of how I feel I can help Main Street meet Wall Street. If you have any questions, Main Street, if there's anything you want to talk about, anything you want to share, just let me know. Just reach out. Thanks again. Marcus Sturdivant, Main Street meets Wall Street. Covered a lot of ground today. From the shadow banking explosion weird mechanics going on with the interest rates and the lack of transparency in your own retirement portal. It's easy to look at this black box and feel like the game is rigged. But remember, fog only works if you stay in it. By even watching this deep dive, you're already ahead of 99% of retail investors. You aren't just a pastor anymore, you're an operator. It's exactly why we built the Wall Street South Journal and the Main Street Meets Wall Street podcast and my total YouTube experience. By the time this hits, we may already be at 1,000 subscribers, wanting to bring the facts that are helping Main Street meet Wall Street. People need a new set of tools. If you haven't joined us yet, hit that subscribe button on check me out on LinkedIn and the podcast. I'm not just reporting the news, I'm translating the plumbing of finance so you can protect what you've built. Yeah, don't forget your homework. I know it's going to be scary after today. Log in tonight, level 3 assets, then use Monarch Money to map out your true liquidity to see where you're at. And when you can see the whole board, you can make moves that Wall Street never saw you make. Thank you for being a part of this journey. We're just getting started. We're just clearing the fog. I'm Sturdivant Sr. It's been a quick dive into the 401k, private credit, shadow market. Keep asking the hard questions. Main Street Meets Wall Street podcast. New episode dropping on the debt. Check it out. I've spent a lot of time tracking these weird money moves. And for nearly 1,000 subscribers of the Wall Street South Journal and on the Main Street Meet Wall Street podcast, we've seen a sounding transparency gap. Today I'm taking a deeper dive than I ever have before. I'm going to show you exactly how to audit your own retirement plan. Also why using a tool like Monarch Money, which I'm a sponsor affiliate with, to shine a light into your liquid cash, give you more expense. I'm going to give you a playbook Wall Street doesn't want you to have. It's time to stop being a passive passenger in your own future. Join the nearly 1,000 plus people clearing the fog. Click the link, watch this video, listen to the podcast. Knowledge is power. Don't let your future be a mystery.